Good evening, everyone. Welcome back to my channel. Today, we'll continue to look at the latest market developments. Yesterday, we mentioned that the market was consolidating in a low-level weak zone. We even drew the trend line for you. Then last night, after an oversold move, Bitcoin staged a rapid rebound and quickly reached the line we drew yesterday. What is that line? It's the line we identified as evidence that price was still consolidating within a weak zone. We said it was still a weak consolidation. What does weak consolidation mean? It means the lows are getting lower. Each low is lower than the previous one. Yesterday, we connected the two recent highs, and today, price rebounded in one move up to that level. So the question is, what happens next? First, what is our trading principle? We make reasonable inferences, reasonable assumptions, but we do not make predictions. A prediction is essentially guessing. A reasonable inference is based on structure. After such a prolonged decline, price is now consolidating in a very weak manner. Has there been any major fundamental improvement? It seems that after NVIDIA's strong guidance, concerns about an AI bubble were temporarily eased. The US stock market rallied strongly. Of course, we know that during periods of sharp volatility, Bitcoin's correlation with US equities is very high. But over the broader trend, it still moves independently. Many people say Bitcoin simply follows US stocks. But how do you explain the fact that US stocks have risen significantly while Bitcoin has fallen so much? So this requires a more comprehensive analysis. Today, Bitcoin's capital flows appear to have turned from negative to positive. In previous days, there were continuous net outflows, but now ETFs have begun to show net inflows. Overall market sentiment, investor confidence has slightly stabilized and recovered. Bitcoin used to be seen as a hedge asset. Now it is treated more like a risk asset. Investors typically only focus on it when risk appetite is high. The key question is whether this risk appetite can be sustained. That determines whether Bitcoin has truly stabilized here, whether it has bottomed, whether this is a dip buying opportunity, or whether a real rebound can begin. So let me ask you a question. Do you think the AI bubble has already burst at this stage or not? The answer is obvious. The bubble is still inflating, it hasn't burst. As long as that bubble has not burst, the first point is this: AI-related stocks and the AI industry as a whole offer higher certainty of return compared to crypto assets. That's the first factor. Second, if the bubble hasn't burst, then risk is still accumulating. And when risk eventually needs to be reduced, what is the first type of asset investors will sell? It will be assets widely perceived as high risk, namely crypto assets. Therefore, 2 days of net inflows alone do not prove that new capital has truly entered the market. It does not prove that large institutional funds have stepped in. And it certainly does not prove that new money is sufficient to absorb the existing trapped positions in the market. It cannot demonstrate any of that. So from a fundamental perspective, the key conditions are still not in place to say that we can start bottom fishing aggressively. The conditions simply are not there yet. Previously, we also analyzed the larger cycle. On the higher time frame, price has only just re-entered the discussion range from early 2024. It has not yet entered the final capitulation phase, the kind of rapid decline with heavy position turnover and accelerated distribution. That stage has not arrived. So what stage are we in right now? Let's review the typical phases of a bear market. First, the euphoric peak. Second, rapid deleveraging. Third, panic. Finally, a more orderly liquidation and position rotation phase. We have not reached that final phase yet. From a macro perspective, this means we cannot justify large-scale long positioning, especially in spot markets. Large long exposure is not appropriate at this stage. Now let's shift to the short-term view. For those trading derivatives, the focus is different. Some of you asked, yesterday we mentioned that price had reached a descending trendline resistance. Now that it's at this resistance level, will it break upward or will it stall and move back down? That's the key question. There are only 3 possible scenarios. First scenario, price forms a range, a box consolidation at this level. Will it build a box here? Will it create a range structure here? Let's roughly draw that box. That's the first possibility, a range. Second scenario, is this a build-up for an upside breakout, a breakout move to the upside? That's the second option. Third scenario, it continues a weak consolidation, a weak structure overall. After reviewing the fundamentals and the larger cycle, I can give you a direct conclusion. This is a weak box consolidation. No matter how long this box consolidates, and even if there are temporary upside breakouts, the overall mindset should remain focused on identifying short opportunities. The framework should be to look for short signals rather than preparing for aggressive long positioning. On the 4-hour chart today, after reaching this level, price paused briefly. This is actually a valid short entry area. Why can you open a short here? Because your stop loss is very easy to define and it's very tight. Look at this 4-hour candle, the top of this candle right here, that's your stop loss level. If you enter short here, your downside space is this large while your upside risk is only this small. The risk-reward ratio is very favorable. Could it still break upward? Of course. If it breaks, you stop out. That's how every trade works. When you find an opportunity with a reasonable risk-reward structure, you take it. Even if by the time this episode is uploaded, the price has already moved higher, that's fine. As long as it hasn't broken the key resistance level, you can mark that resistance as your stop loss. If it has already broken above resistance, then you look for something like an upper wick rejection. If there's no such signal, then you simply don't trade. But as of now, this is a very solid trading zone. Looking at Ethereum, it's a similar setup. It just slightly pierced the descending trendline resistance we drew yesterday, but it formed two upper wicks. That makes this area a very good short entry as well. The stop loss is also easy to set. Although the stop may be slightly wider than Bitcoin's, the potential reward is correspondingly larger. The risk and return are aligned, so this is also a very good short opportunity. That's it for today's session. Tomorrow we'll review how the market evolves and see whether it aligns with our current trade setup. As those who follow regularly already know, trade execution and market evolution are two separate things. They are not the same. We focus on executing each trade correctly according to our plan. That concludes today's sharing. Remember to like, follow, or join the group discussion. We'll continue tomorrow.